In 2025, the surface still looks unbreakable. The aircraft carriers still patrol distant seas. The dollar still settles oil contracts. Silicon Valley still shapes the digital world. Wall Street still sets the tone for global markets before most of the planet wakes up. On paper, the United States remains the central pillar of the international system. Its military footprint spans continents. Its currency anchors central bank reserves. Its technology companies define entire industries. Its universities absorb the world's brightest minds. Its cultural influence seeps into everything from film to fashion to finance. If power were measured in symbols alone, the story would end there. But power is not symbols. Power is structure. And structures can weaken long before they visibly crack. Look past the parades and stock indices. Look past quarterly earnings and defense budgets. Strip away the prestige. What remains is something more mechanical, more fragile, an operating system built not primarily on production, but on privilege. There is a number quietly tracking that privilege. In 2000, the US dollar made up roughly 71% of global foreign exchange reserves. By 2024, that share had fallen to around 58%. Not collapse, not crisis, just erosion. But steady erosion in systems like this is rarely random. Most Americans never think about reserve currency status. It sounds technical, distant, abstract. Yet the standard of living of 330 million people rests on that abstraction. The ability to issue the currency the world needs has allowed the United States to import more than it exports, to run deficits without immediate consequence, to borrow at scale without triggering panic. It has allowed consumption to outpace production for decades. That privilege feels permanent. It feels like a natural law. But it is not a law of physics. It is a political and economic arrangement, and arrangements can change. Nothing dramatic has happened yet. Supermarkets are stocked, credit cards swipe, treasury auctions still clear. But beneath that stability, pressures are building. Fiscal deficits have become structural. Interest payments are climbing. Industrial capacity has thinned. Trade imbalances persist. Individually, none of these trends guarantees decline. Together, they form a pattern, and patterns in economic history tend to resolve. The real question is not whether the United States remains powerful today. It clearly does. The question is whether the foundations beneath that power are strengthening or slowly shifting. Because when foundations move, outcomes that once seemed impossible begin to feel plausible. To understand where this trajectory leads by 2035, we have to look beyond headlines and examine the mechanisms that have sustained American prosperity for half a century, and ask what happens if those mechanisms begin to fail. And that is where the story becomes less comfortable. Because the visible dominance of today rests on decisions made decades ago, decisions that reshaped the entire global monetary system. The modern American system did not begin with Silicon Valley. It began with a fracture. In 1944, as World War II was nearing its end, delegates from 44 nations gathered in Bretton Woods, New Hampshire. The agreement they forged placed the US dollar at the center of the global financial system. Other currencies would be pegged to the dollar, and the dollar itself would be convertible into gold at $35 per ounce. This gave the system credibility. Dollars were not just paper, they were claims on something tangible. For decades, it worked. The United States was the world's industrial powerhouse. It produced more than it consumed. It held the majority of the world's gold reserves. Trust in the dollar was reinforced by real output: steel, machinery, automobiles, electronics. But by the late 1960s, the arithmetic was changing. The United States was financing both the Vietnam War and expansive domestic programs. Dollars were flowing abroad faster than gold reserves could credibly support.
Foreign governments, particularly France, began to notice. They started exchanging dollars for gold. U.S. gold reserves fell sharply. By 1971, the pressure had become unsustainable. The promise that every dollar could be converted into gold at a fixed price was mathematically impossible to keep. There were simply too many dollars relative to the gold backing them. On August 15, 1971, President Richard Nixon went on national television and announced the temporary suspension of dollar convertibility into gold. Temporary became permanent. The gold window never reopened. With that decision, the global monetary system shifted into a new era, fiat currency. The dollar would no longer be backed by a physical commodity. It would be backed by confidence, by economic strength, and by geopolitical power. Under normal circumstances, such a move might have triggered a collapse in trust. A currency untethered from gold should have weakened dramatically. But something else happened. In the early 1970s, amid oil shocks and geopolitical tension, the United States negotiated an arrangement with Saudi Arabia. Oil would be priced and traded exclusively in dollars. In exchange, the U.S. would provide military protection and security guarantees. The petrodollar system was born. Every country on Earth needs energy. If energy is priced in dollars, then dollars become necessary for global trade. Central banks accumulate them. Governments hold them. Trade flows revolve around them. In effect, the gold backing was replaced by oil demand. The dollar became the lubricant of the global economy, and because the United States controlled the supply of that lubricant, it gained a powerful advantage. It could issue liabilities that the rest of the world needed to hold. This was not a conspiracy, it was strategy, and at the time it worked brilliantly. But systems built on privilege rather than production carry a hidden risk. If demand for the privilege weakens, the entire structure must adjust. For decades, the arrangement masked growing imbalances. Trade deficits widened, but foreign governments recycled their dollar earnings into U.S. Treasury bonds. Budget deficits expanded, but borrowing costs remained manageable. Consumption outpaced manufacturing, yet imports remained affordable. It felt like evolution, the transition to a post-industrial economy driven by finance, services, and knowledge. Yet beneath the surface, a subtle shift was occurring. The United States was moving from being the world's largest producer to being the world's largest consumer, financed by a currency the world was willing to hold. As long as global confidence in that currency remained unquestioned, the system could persist. But confidence is not static. And once doubt begins to creep, even slowly, the privilege that once seemed permanent can start to erode. The decision in 1971 severed the anchor. The petrodollar system replaced it with momentum. For half a century, that momentum sustained American dominance. The question is, what happens when momentum begins to slow?
For much of the 20th century, American power was visible in smokestacks. Steel poured from mills in Pennsylvania. Automobiles rolled off assembly lines in Detroit. Electronics, machinery, chemicals. The United States did not just consume the modern world, it built it. Manufacturing once accounted for more than 20% of American GDP. Industrial jobs supported a broad middle class. Wages rose alongside productivity. The financial system existed largely to serve production. Banks took deposits and lent to businesses. Capital funded factories, research, and infrastructure. Finance was a utility, important but secondary to the real economy. Then something changed. By the late 1970s and early 1980s, inflation had surged, competition from Japan and Germany intensified, and corporate America faced pressure to boost shareholder returns.
At the same time, new financial instruments, deregulation, and technological innovation made capital markets more powerful than ever. Gradually, the center of gravity shifted. The language of business began to revolve around quarterly earnings, stock buybacks, and return on equity. CEOs were increasingly compensated in stock options, tying their wealth directly to share price performance. Wall Street analysts rewarded cost-cutting and outsourcing more than long-term investment. Manufacturing margins were modest. Financial engineering was lucrative. In 1950, the financial sector represented a small slice of the American economy. By the early 2020s, finance and related services accounted for roughly 1/5 of GDP. Finance had grown faster than manufacturing. In fact, it had grown at manufacturing's expense. Manufacturing moved overseas, particularly to China after its accession to the World Trade Organization in 2001. Corporate America discovered that global supply chains could dramatically reduce labor costs. Consumers benefited from cheaper goods. Corporate profits expanded. Stock markets soared. On the surface, this looked like efficiency. But efficiency for whom? Between 2000 and 2024, the United States lost millions of manufacturing jobs. Entire regions, the industrial Midwest in particular, experienced stagnation. Communities built around factories struggled to adapt. Service sector jobs replaced industrial work, but often at lower wages and with fewer benefits. The shift was not immediate collapse, it was gradual hollowing. Corporate America did not stop making money. In many cases, profits increased. But those profits increasingly flowed to shareholders and executives rather than to reinvestment in domestic productive capacity. Stock buybacks became a defining feature of corporate strategy. Rather than expand factories or fund research at scale, companies used profits and sometimes borrowed funds to repurchase their own shares, boosting stock prices and executive compensation. From a narrow financial perspective, it made sense. From a systemic perspective, it altered the structure of the economy. The United States became less dependent on making physical goods and more dependent on managing financial assets. GDP growth increasingly relied on asset appreciation, real estate, equities, derivatives, rather than on expanding output of tangible products. This transformation was celebrated as progress. The knowledge economy, the service economy, the idea that advanced nations naturally evolve away from industry. There is truth in that narrative. Mature economies often specialize in higher value services, but there is a difference between specialization and dependency. When COVID-19 disrupted global supply chains in 2020, the vulnerabilities became visible. Shortages of semiconductors stalled automobile production. Medical equipment supply was strained. Rare earth minerals, critical for advanced technologies and defense systems, were overwhelmingly sourced from abroad. Dependence is manageable in stable times. It becomes strategic weakness during tension. At the same time, trade deficits widened. The United States consistently imported more than it exported. Those deficits were financed not by exporting more goods, but by exporting financial assets, treasury bonds, equities, and dollar liabilities. In essence, America was sending paper abroad and receiving products in return. This arrangement functioned as long as the rest of the world was willing to accumulate that paper. But the more the domestic economy shifted towards finance and away from production, the more the underlying capacity to generate export strength weakened. The dollar's role masked the imbalance. The reserve currency status absorbed the strain. The question is not whether financialization created wealth. It clearly did, particularly for asset owners. The question is whether an economy centered on asset inflation rather than on industrial capacity can sustain relative prosperity when the external demand for its currency begins to change. Because if production no longer anchors strength and currency privilege begins to soften, the adjustment does not happen on Wall Street first. It happens in living standards, and that is where the trajectory towards 2035 becomes more than a theoretical exercise.
Industrial erosion alone does not determine national decline. Economies can adapt, they can pivot, they can rebuild. But adaptation requires fiscal flexibility, and this is where the mathematics grow heavier. At the turn of the century, U.S. federal debt stood at roughly $5.8 trillion, about 55% of GDP. Today, it exceeds $34 trillion and sits above 120% of GDP. The raw number is startling, but the ratio tells the deeper story. The country has accumulated obligations faster than its economy has expanded. Deficits have become structural. In good years and bad years, in wartime and in relative peace, spending has exceeded revenue. The United States has not recorded a sustained budget surplus in more than 2 decades. Debt in itself is not fatal. Growing economies can manage large liabilities. The real pressure emerges when interest payments begin to crowd out everything else. In 2020, federal interest payments were manageable by historical standards. By the mid-2020s, they had nearly tripled. As older low-rate bonds roll over into higher-rate financing, the cost of servicing the debt climbs. By the early 2030s, interest payments are projected to rival or exceed major spending categories such as defense or Medicare. When a government spends more to service past borrowing than to invest in the future, options narrow. There are only a handful of pathways out of a debt overhang. Default is politically catastrophic for a reserve currency issuer. Severe austerity risks recession and social unrest. That leaves the quiet option, inflation. Gradually erode the real value of debt by allowing prices to rise. Inflation is rarely declared as policy. It emerges through monetary accommodation, through fiscal expansion, through the subtle preference for growth over stability. It transfers wealth from savers to debtors, from fixed incomes to asset holders. In the United States, the expansion of the money supply after 2008, and particularly after 2020, was unprecedented in scale. Extraordinary crises justified extraordinary responses, but the long-term effect has been to reshape expectations. Inflation, once thought conquered, reappeared. For households with appreciating assets, inflation can feel manageable. For those reliant on wages and savings, it feels corrosive. Purchasing power declines quietly. A grocery bill that once felt routine begins to feel heavy. This is not hyperinflation. It is not chaos. It is gradual adjustment. But gradual adjustments compound. The sustainability of U.S. debt ultimately depends on one crucial factor: continued demand for Treasury securities. As long as foreign central banks and global investors view Treasuries as the safest asset in the world, the system functions. Borrowing costs remain contained. Confidence holds. Yet this returns us to the earlier thread. If reserve currency dominance weakens, if the dollar's share of global reserves continues to decline, the automatic recycling of foreign trade surpluses into U.S. debt may diminish. A subtle shift in foreign demand for treasuries can alter the entire fiscal landscape. Debt is manageable in isolation. Debt becomes destabilizing when paired with slowing growth, rising interest rates, and declining external demand. The arithmetic does not announce itself dramatically, it accumulates quietly. And when arithmetic accumulates quietly for long enough, it tends to assert itself suddenly. The United States still has time, it still has flexibility, but the margin for error is narrowing. And the global context in which this debt must be managed is also changing. Because while America has leaned further into finance and borrowing, another economy has been building something very different.
Over the same decades that the United States pivoted towards financialization, China moved in the opposite direction. In 1980, China's economy was smaller than that of many European countries. Its industrial capacity was limited, its global influence modest. Then came 4 decades of relentless expansion. China invested heavily in manufacturing, infrastructure, and export capacity. It built ports, railways, power grids, and entire cities. It became the world's largest producer of steel, cement, solar panels, electronics, and increasingly advanced technologies such as electric vehicles and batteries. By the 2020s, China had surpassed the United States in purchasing power parity GDP. It became the largest trading partner for more than 120 countries. Its share of global manufacturing output rose above 30%, more than that of the United States, Japan, and Germany combined. This was not accidental, it was strategic. Where American corporations outsourced to cut costs, Chinese policy emphasized industrial capacity and technological self-sufficiency. China's state-led model has inefficiencies. It faces demographic headwinds and debt concerns of its own, but it retains one structural advantage: production. Production anchors trade surpluses. Trade surpluses anchor foreign reserves. Foreign reserves anchor currency confidence. Unlike the United States, China runs consistent trade surpluses. It exports more goods than it imports. It accumulates foreign currency, rather than relying on others to absorb its liabilities. Moreover, China has invested aggressively in strategic sectors: semiconductors, renewable energy, artificial intelligence, advanced manufacturing. It seeks not just volume, but technological depth. This divergence in economic structure matters. A nation that produces tangible goods at scale possesses leverage in global trade. A nation that consumes more than it produces relies on financial arrangements to bridge the gap. If global supply chains fragment due to geopolitics or strategic rivalry, countries will prioritize reliable producers. Manufacturing capacity becomes strategic insurance. China's Belt and Road Initiative extends its economic reach across Asia, Africa, and parts of Europe. Infrastructure loans and trade agreements deepen integration. Meanwhile, the United States retains advantages in innovation, finance, and higher education, but its manufacturing share of GDP has declined to roughly half of what it was in 1980. The question is not whether China will surpass the United States in nominal GDP by a specific year. Forecasts vary, growth trajectories fluctuate. The deeper question is structural. Which system is positioned to generate real output growth over the next decade? If American growth relies heavily on asset appreciation and consumption financed by borrowing, while Chinese growth leans on production and export expansion, the gap in relative purchasing power could narrow. By 2035, poorer may not mean absolute decline. It may mean relative erosion. Slower wage growth, higher import costs, diminished purchasing power compared to a rising competitor. Relative decline reshapes global influence, and global influence, in turn, shapes currency demand. Which brings us back to the reserve currency question and the accelerating trend of diversification away from the dollar.
The dollar remains dominant. That must be stated clearly. It still accounts for the majority of global reserves. It still anchors global trade. But dominance is not binary. It is incremental. Since the late 1990s, the dollar's share of foreign exchange reserves has gradually declined, not collapsed, declined. The euro gained some share. Gold purchases by central banks accelerated. Regional currency arrangements expanded. The shift gained momentum after 2022, when the United States and its allies froze a portion of Russia's foreign reserves in response to geopolitical conflict. For many countries, this was a wake-up call.
Holding reserves in a currency that can be restricted carries risk. Sanctions are a powerful tool, but power used frequently can encourage diversification. China and Russia increasingly conduct bilateral trade in local currencies. Some oil exporters have explored pricing energy in alternatives to the dollar. BRICS nations have discussed settlement mechanisms outside traditional Western systems. These developments are gradual. They do not dethrone the dollar overnight, but they chip at exclusivity. Reserve currency status depends on network effects. The more widely a currency is used, the more convenient it becomes. But network effects can reverse once usage falls below certain thresholds. History offers precedent. The British pound once dominated global finance. After World War II, as Britain's economic weight diminished and the United States rose, the pound's share declined steadily. The transition took decades, but it occurred. If the dollar's share falls below 50% of global reserves in the early 2030s, the psychological shift could be significant. Investors may diversify more aggressively. Borrowing costs could edge higher. Exchange rates could become more volatile. For a country with persistent trade deficits and high debt, even modest increases in financing costs matter. Imagine a world in which the United States must offer higher yields to attract buyers for its debt, while simultaneously facing slower growth and rising entitlement costs due to demographic aging. The fiscal room shrinks. And if import prices rise due to currency depreciation, American consumers feel it directly. Everything from electronics to clothing to industrial inputs becomes more expensive. Relative living standards adjust. The shift does not require catastrophe, it requires momentum. Momentum is subtle. It builds quietly. It alters incentives gradually. And once enough actors believe the trend is durable, behavior changes. By the early 2030s, the question may not be whether the dollar collapses. It may be whether it retains the same unquestioned centrality it once enjoyed. If it does not, the economic advantages that accompanied that centrality begin to fade. And fading advantages translate into measurable differences in income, wages, and purchasing power. When we speak of one nation becoming poorer than another, we often imagine dramatic collapse. That is rarely how relative decline unfolds. It is quieter. Real wages stagnate. Housing becomes less affordable. Healthcare consumes a larger share of income. College costs climb faster than salaries. Infrastructure ages. Social mobility slows. Meanwhile, in another country, wages rise steadily. Domestic consumption expands. Technological capacity deepens. Infrastructure modernizes. The gap narrows. In the United States, median real wage growth over the past 2 decades has been modest compared to earlier post-war decades. Productivity gains have increasingly accrued to capital rather than labor. In China, despite recent slowdowns, real incomes have risen significantly over the long term. Hundreds of millions have entered the middle class. Urbanization continues. By 2035, if China's per capita income continues to converge upward, while U.S. real wage growth remains subdued, relative comparisons may look different. The United States will likely remain wealthy in absolute terms, but relative global positioning matters for influence, investment flows, and perception. If China's economic scale surpasses that of the United States by a clear margin, global institutions and trade relationships will adjust accordingly. Capital tends to follow growth. Markets reprice risk. Investors seek dynamism. This is not about ideology, it is about arithmetic and momentum. The American model, heavily financialized, consumption-driven, reliant on debt, has delivered extraordinary prosperity for decades, but its resilience depends on continued external confidence. Chinese model, state-guided, production-focused, export-oriented, carries inefficiencies but anchors growth in tangible output. Which model proves more durable in the 2025 to 2035 window remains an open question. But trends matter, and the current trends suggest a narrowing of relative economic weight. Relative weight influences currency demand. Currency demand influences fiscal flexibility. Fiscal flexibility influences living standards. The chain is long, but it connects. If the United States loses even a portion of its reserve currency advantage while facing structural debt burdens and slower productivity growth, American households could experience a decade of subdued real income growth. Meanwhile, if China sustains moderate expansion and technological upgrading, its aggregate wealth could surpass that of the United States decisively. In that sense, poorer may not signal collapse, it may signal relative decline in purchasing power and global leverage. And relative decline reshapes the global order.
No empire collapses on schedule. No forecast unfolds exactly as predicted, but structural forces exert pressure. By 2035, several dynamics could converge. First, demographic aging in the United States will strain entitlement programs. Social Security and Medicare obligations will rise relative to the working-age population. Fiscal pressures intensify. Second, interest costs on accumulated debt will remain elevated unless growth accelerates significantly. Servicing past borrowing will limit new investment. Third, incremental diversification away from the dollar may continue. Even a modest decline in reserve share alters financing conditions. Fourth, technological competition will intensify. If China leads in key sectors such as electric vehicles, batteries, renewable energy infrastructure, and parts of artificial intelligence manufacturing, its export strength will persist. These forces do not guarantee American impoverishment, but they increase the probability of relative erosion. The United States still retains enormous strengths: innovation ecosystems, entrepreneurial culture, deep capital markets, rule of law, and military capability. It is not destined for collapse. Yet structural advantages are narrowing. If by 2035 China's economy, measured in purchasing power or nominal terms, significantly exceeds that of the United States, and if its middle class continues expanding while American real wage growth remains muted, global perceptions of wealth will shift. American consumers may find imported goods more expensive. Housing may remain costly relative to income. Fiscal adjustments may limit public investment. Meanwhile, Chinese households could experience rising consumption, expanding infrastructure, and growing technological access. Relative prosperity influences global leadership, and leadership, once questioned, becomes harder to reclaim. The coming decade will not be defined by a single dramatic event. It will be defined by accumulation of debt, of demographic pressure, of shifting trade patterns, of evolving currency preferences. By 2035, the outcome may not look like collapse. It may look like recalibration. A world in which the United States remains powerful but no longer singular. A world in which China's aggregate economic weight exceeds that of America. A world in which relative purchasing power tilts eastward. History rarely moves in straight lines, but it often rhymes. For half a century, the United States benefited from a monetary architecture that amplified its strength. That architecture is evolving. Whether America adapts by rebuilding industrial capacity, managing debt prudently, and renewing productivity will determine the depth of relative decline.
If it does not, the quiet erosion visible today may culminate in a world by 2035 where the center of economic gravity has shifted decisively.